The housing market and real estate have been on a lot of people's minds since both interest rates and mortgage rates started to increase. Many people have feared we might see another 2008-style housing collapse as so many people are pulled out of the housing market owing to these higher mortgage rates. We would argue that there are structural differences between now and 2008, and those higher levels of mortgage rates may not be as impactful to home prices across the country. While increasing rates will tamp down demand for housing, there is an offset on the supply side that should help buffer this trend. Coming out of the financial crisis, we saw short-term rates near zero for over a decade. Long-term mortgage rates followed suit to the point that almost 80% of all mortgages are currently at 5% or lower. This differential between ultra-low rates and today's much higher rate means fewer homeowners are willing to sell their homes, effectively trading a mortgage that could be as low as 3% for one that could be as high as 7%. This lack of sellers means supply is artificially low. So, interest rates impacted both the supply and demand side of the equation, mitigating the impact on prices. The other offsetting factors were around household formation and new home construction. New household formations continued to march along, with post-pandemic formations surging. This momentum continues even as rates continue to rise. As it turns out, starting a family is about more than just interest rates. This demand uplift has been met by new home construction. With a lack of existing inventory coming online, new home builders have stepped into the void. New home sales have recently accounted for almost 30% of total sales, where traditionally they were more like 10 to 12%. So, in a similar vein, the increased demand is being offset by increased supply, which should again mitigate pricing pressure.